overview of Measure Consulting. So we are a consulting firm. We take a very consultative approach to the process of trying to find ways to best attract, retain, a talent in different types of companies, whether they're privately held or publicly traded. We've been doing it for almost 30 years. We like to focus on consulting on both plan design, plan funding and financing, as well as how best to implement the plan and then administrate the plan. And from an administration perspective, we do have our own proprietary technology platform for plan admin, plan accounting, asset liability reconciliation called MAP Benefits. So MAP Benefits is the platform we use to set up the plan, enroll the plan, account, do all the asset liability management, and then provide access to both plan participants and corporate sponsors. From a high level, we're really focused on customization, technology, resources, and all the broad base of services we provide, from consulting all the way to plan admin. Our entire team is based in Tampa. We've got about 40 people that are part of our team. And we like to focus on the art of the possible. So I've had hundreds of meetings with clients, and usually at the end of the meeting, they said, yeah, Mez, that sounds great, but what exactly do you do again? So we were very motivated to try and find a very simple way to articulate our value proposition and where we like to focus. And so this pyramid is a really good representation of where we like to focus. It's color coded because the next question that my finance friends asked was, well, what's this going to cost? So the darker the shade means there's no P&L impact. The lighter the shade means there would be higher level of P&L impact. And obviously on the left is typically the type of executive that might be eligible for any one of these types of plans. So we like to focus and share ideas around off-balance sheet and on-balance sheet, and we're going to be leveraging both of those two categories in our conversation today. So there's lots of different off and on-balance sheet plans. They are very different, obviously, from a financial standpoint. We'll walk through later on the financial impact of an off-balance sheet plan versus an on-balance sheet plan. But some examples of an off-balance sheet plan might be a controlled bonus plan, could be a super Roth, which you saw in the Super Mez video, could be a leverage bonus plan, or even what has become super popular as of late, which is a loan regime split dollar plan, which we're actually going to walk through the mechanics and financial impact of how a loan regime split dollar plan works. On the on-balance sheet side, so here again, on-balance sheet meaning you have an asset on your balance sheet. That asset is typically used to offset a liability. That liability is typically created by a promise to pay an executive some amount of money at some future point in time. So that could be a deferred comp plan. It could be a SERP, supplemental executive retirement plan, or a long-term incentive plan. It could be an executive long-term care plan or a split dollar plan, which would be different than a loan regime split dollar plan. This would be an on-balance split dollar plan. More companies today, we're finding, want to focus on the utilization of their stock. So there's three different ways to do that. You can either match your executives in the deferred comp plan with company stock. You can make stock available as an investment option. So if the stock increases by 10% in a particular year, you would credit the dollars that they deferred into the deferred comp plan by that same rate. And then being able to defer equity forms of compensation. So the part of the Internal Revenue Code that governs non-qualified plans is really what we're talking about here. Whether it's off balance sheet or on balance sheet, it's really non-qualified. Non-qualified means it is not subject to the rules, regulations, and limitations imposed on qualified plans. So being able to defer equity forms of comp like restricted stock units and performance stock units is permissible under 498 of the code, and it's something that's a super hot trend in the market today. So when you compare an off-balance sheet plan to an on-balance sheet plan to retain executives, I'm not going to walk through every one of these, but the biggest differences between the two are the initial contribution amount. So the initial contribution amount in an off-balance sheet plan is after tax versus on-balance sheet, which is pre-tax. And this is really pre-tax from the executive's perspective, and it would be after tax from the executive's perspective. So if it's off balance sheet, the company would get an immediate deduction in the form of compensation, but only the after tax amount would go into the plan. If it's on balance sheet, it would be pre-tax to the plan participant, but the company doesn't get a deduction until they actually pay out plan benefits. There would be benefit security in an off-balance sheet plan, which means it would not be subject to claims of creditors. So any money that was set aside would be effectively risk-free from a corporate claims. That's not the case if it's on balance sheet. If it's on balance sheet, those assets on the balance sheet are subject to claims of creditors, but there are ways to protect benefits and secure plan benefits given a change control, change in heart, a merger acquisition, or the company's inability to pay benefits from a cash flow perspective. In off-balance sheet plans, the earnings on those dollars to the executive are typically tax-free, which is phenomenal. The benefit distributions on the back end are typically tax-free as well. In an on-balance sheet plan, the benefits are tax deferred as opposed to tax-free. So it's wealth accumulating, but on a tax deferred basis as opposed to taxable or tax-free basis. So that's at a high level of differences between an off-balance sheet plan and an on-balance sheet plan. So we have our first survey question. Question is, what do you think it costs a company to lose a member of its executive team? Interesting movement. I don't know if they can see the results yet. Probably not.
I'll share them in just a second, Todd. See, we've got a couple more people.
Looks like
give everybody
I've
about.
already met with a lot of these people a one-on-one before, because a lot of them are getting the right answer.
Okay, well, there are your results. Good to go.
So yeah, the right answer is 300% of salary. So that is the correct answer. And so to give you a little bit more perspective on cost, and oftentimes we're engaged to just explain what the real impact would be by losing a key person or several key people. And most companies think about and understand the fixed costs of losing someone, the recruiting, the interviewing, the admin costs, but a lot of people tend to forget those hidden costs, which are the variable costs. So, lost productivity, employee morale, maybe a relationship with one of your largest clients might go out the door. So that's a much bigger puzzle piece around that 300%. If you put some numbers to that, and you think about it in terms of, well, what if we only have 2% turnover, even 5% turnover at the executive level, and you have, 50 executives, 100 or 200 executives, you can look at the financial impact to the company can be quite substantial, even into the millions of dollars by losing even something as small as 2 to 5% of your executive team. So very, very impactful. So second question would be, how concerned are you about losing a member of your executive team? not surprising, looking at the polling results.
They're the final results, Todd. It's good to go.
Okay. I'm glad to see that no one checked, haven't thought about it. That's kind of a good thing. But yeah, it looks like most people are somewhat concerned or very concerned. So let's talk about a couple of on-balance sheet plans to give you a better idea of what those plan designs might look like and what the financial impact of those plans might be. So the first plan that we'll talk about is a deferred compensation plan, which, as mentioned earlier, is on balance sheet and it is a non-qualified plan. These are typically voluntary plans. They might have company matches or company contributions associated with them, but predominantly they're really championed as a supplement to a 401k plan. So everyone knows that you're limited to deferring $20,500 into a 401k plan. This would give the highly compensated group, highly compensated by IRS definition, is $130,000 or more in total comp. You can also include management employees as a part of that group as well. But the focus is being able to defer income, salary, bonus, incentive comp, equity forms of comp, even severance in many cases, defer that into a plan effectively without limit. So if you wanted to allow people to defer 100% of their total comp, you could actually allow for that to happen. The economics of that to the executive are probably not surprising. So we thought it would be of value to give you real life examples. So this is an executive, they're age 45. They're looking to defer $50,000 a year for 10 years, as opposed to taking that $50,000 as income, paying taxes, and then reinvesting that in a taxable securities portfolio. We assumed a rate of return of 8%, retirement age of 65, and then a 20-year payout. And at 37%, and here again, this is comparing apples to apples. So this is cumulative after-tax benefits received by the executive. There's over $1 million difference between taking that $50,000 as income versus deferring that $50,000 and paying tax on the actual back end. So that's $1 million advantage in that case. We like to model it in a couple of different other tax scenarios, one at 45%, the other one being a blended rate. In every case, it's better than 100% advantage to defer income and warehouse cash on a pre-tax basis versus paying taxes and reinvesting it at a taxable rate of return. If there's any questions along the way, feel free to ask the questions. I think I've got no questions yet. I've got a thank you. I don't know what that was for, but you're welcome. Let's see. So that's deferred comp. So that's more of a voluntary plan. But the other plan that we wanted to share is a long-term incentive plan. So long-term incentive plan is best described as defined contribution SERP, SERP being a supplemental executive retirement plan. So these types of plans are typically championed internally within a company as a long-term incentive plan. So it's a cash contribution that's made into a plan based on either corporate performance metrics, personal performance metrics. Those contributions will more than likely vest over a period of time. There'll be different payout options associated with those contributions. There could be a non-compete tied to that cash account. There could be some flexibility for earlier distributions. Generally just depends upon the actual plan design. But when you're talking about plan design, you're really looking at really three different components. What do we want the contribution amount to be? How's it going to vest? And how do we want to credit them on what's been allocated into the plan? And then when do we want to pay out all these dollars? So from a contribution amount, the first thing that's important to identify is who do you want to make eligible? And then the contribution amount really comes next, which can be a percentage of salary, bonus, total comp, could be a percentage of EBITDA, which is then distributed across the executive team on a pro rata basis. We just designed a plan recently for a large privately held company in the Midwest. And their contribution amount was based on a percentage of the increase in the value of their company. So this particular CEO wanted to drive value, and he wanted to share the increase of that value with his executive team. From a vesting perspective, you can have different vesting schedules for different plan participants. So you can vest differently if you're a VP versus an SVP versus a C-level executive. You can have the actual plan year contribution vest or the entire account balance vest. So lots of optionality there. And then in terms of access to the funds, we've seen a lot of different things. We've seen where the company says, look, we're going to set aside this money. Whatever you're vested in, you're actually going to get, but you're not going to get it until normal retirement age. We've seen other clients where they allocate dollars and they say, well, you can get access to, for example, 50% of your vested balance within the first 10 years that you are participating in that plan. Most of the plans that we do put in place are subject to some kind of a non-compete. So there might be a 1-year waiting period until a distribution is actually made unless they're employed at the company. One of the things that we've been seeing a lot as it relates to long-term incentive plans are special contributions, or what we like to call signing bonuses and other things for business athletes. We labeled the business athlete, which are typically C-level executives or really important hires where you're trying to do something special to kind of lure them over to the company. Recently, we had a client that won over a CTO because they provided her with $1 million signing bonus. Now, that might sound crazy, right? $1 million of signing bonus. The reality is it's going to vest over a 5-year period of time. So she might actually see $1 million in her account, but there's zero vesting in the first 2 years. And then it starts to begin to vest to where it becomes 100% vested after 5 years. And all that's based on performance. So the CEO, the board's thought process is, if she can deliver value for that period of time and she's still with us, she's worth, probably 5 or 10 times that signing bonus amount. So at the end of the day, it really comes down to, great, I'm concerned about losing a key person. I understand what it might cost to lose that key person, but what's it going to cost to keep them at the company? And it's really that cost benefit analysis. And so this is a very simple graphic that shows that if an executive was earning $250,000 and the cost to the company was just 200% or $500,000, and they made alternatively said, look, this is a really key person, we really want to lock them into the company. Let's create a long-term incentive plan, and let's make $50,000 contributions in the plan over 5 years. That's $250,000 worth of contributions. That's going to be 50% less cost to the company if they did in fact lose that key person. And then the benefits to the executive, in this example, assuming a 7% rate of return, is going to be $1.5 million. So it's a win-win for everyone. The company wins because they get to lock in this key person and allow them to continue to deliver value. And it's a huge win for the executive because they're incentivized to stay with the company because they have this huge windfall of cash of about $1.5 million. Now, a lot of you are probably saying, well, that's great from a conceptual perspective, but how does that actually work from an accounting and P&L standpoint? So here's the details behind that basically high level summary. So if you start in column 1, that's a $50,000 contribution. Their company's going to credit them interest. That interest can be based on what the plan participants invest the money in, or what the company invests the money in, or some combination. That's going to create an annual accrual cost each and every year for the company. But note that there's a vesting schedule. So in this example, it's a 5-year class vesting. Class vesting means that each year's contribution vests over a 5-year period of time. So we have a vested annual accrual cost. You can see the retirement benefits in column 5 of about $1.5 million. So this person's going to get about $75,000 a year over a period of time. Column 6 is a liability that's on the balance sheet. That's essentially the account balance of this particular executive. Column 7 is a vested account balance. Column 8 is your DTA. In anticipation of taking that deduction sometime out into the future, when benefits are going to be paid, you get to take a DTA today in anticipation of that. So your net benefit expense is column 9. So that's the $9,800 expense for the $50,000 contribution. So that's column 4, which is the vested annual accrual cost offset by the DTA. But it's not over. That's just the liability side. The company's actually going to invest $50,000. That $50,000 is going to earn a rate of return. And then those earnings, that asset is effectively going to offset that liability. And so you're really looking at the earnings in column 11 are offset by the annual benefit expense, the actual P&L impact in column 9. That gives you a net P&L impact of $7,000, and you see it grow as the vesting begins to pick up, and then it starts to go positive as the assets start to grow and build on a tax favored basis that in effect offset the liability that's on the balance sheet of the company. So that's some little bit of granular detail behind a sample executive and a long-term incentive plan contribution of $50,000 over 5 years. No questions? This is fantastic. So it's important to understand that there's really 2 different ways to fund and finance that obligation or that liability on the balance sheet. You can either use taxable securities or non-taxable securities. Taxable securities can be something like mutual funds. Non-taxable securities are typically some corporate and life insurance structures. So there's benefits, obviously, to both, but from a tax perspective, the non-taxable securities, the earnings are not going to be taxed to the corporation. They're going to be able to have favorable upstreaming of cash flow on a tax saver basis. And then the P&L impact of the plan typically goes positive at some future point in time to the favorable tax structure. At the end of the day, from a conceptual standpoint, when you compare taxable securities and non-taxable securities, the cost of taxable securities is actually the tax the corporation's paying on the earnings. The cost of the non-taxable securities of a portfolio is really the structure costs, which tend to be about 100 basis points. So that delta in this example, 120 basis points, is the incremental value proposition between taxable securities and non-taxable securities. Obviously, taxable securities COLI being the asset structure that is the most favorable. So those were 2 examples of on balance sheet plans, the deferred compensation plan, which is a voluntary plan, and the long-term incentive plan, which is a plan that requires a company to make contributions over a period of time. Now let's talk a little bit about off balance sheet plans. So we're going to talk about the Super Roth first, and then the loan regime split dollar plan next. So just at a high level, conceptually, the Super Roth allows for after-tax contributions. The earnings on those contributions grow income tax-free. The distributions from the plan can be taken out income tax-free. They can reallocate and de-risk their portfolio, meaning they can move out of equities and into fixed income and back and forth without any tax costs. There's tax-free survivor benefits. It could even be personally asset protected from personal claims of creditors. There's complete liquidity. And then obviously within the Super Roth, there'd be access to institutional managers. The mechanics of how a Super Roth would work. And here again, this could be a company contribution or an executive voluntary contribution. If it's a company contribution, that is oftentimes referred to as a controlled bonus plan. The word control is in there because the access to the cash is limited by whatever the vesting schedule is. So that's totally controlled by the company. So if there's a $500,000 account balance that's 50% vested and the executive were to leave, $250,000 of what was allocated would come back to the company in that particular situation. But contributions are made after tax. Those dollars are then delivered to an insurance carrier, which then delivers them to institutional managers. Because it's part of an insurance structure, all of the earnings would be income tax-free back to the participant in this plan. And then they'd also be able to receive tax-free benefits on the back end over any period of time that they had elected to take a distribution. Could be in lump sum, could be over 10 years, 20 years, whatever works for that particular executive. So when you compare taxable securities to a Super Roth, meaning if you already have after-tax money and you're going to be investing that in a managed portfolio, there are some advantages to doing that. But there's more advantages to looking to allocate some of those dollars into a Super Roth structure. By the way, the word super in Roth really means no limits. So you could put in 100,000 a year, $1 million a year, 10 million a year. There are no limits as to what you can put in to a Super Roth on an annual basis. Obviously, with a Roth IRA, there are significant limitations in what you can put in to those plans, because once again, that's a qualified plan, versus a Super Roth being a non-qualified plan. There are two negatives to Super Roths. One is that there could potentially be legislative risk, meaning this is one of the last few structures left in America that's not subject to tax. Is it oftentimes attacked? I wouldn't say often, but every, I would say 5 to 8 years, there is some proposed legislation to eliminate those. The only saving grace is that from a historical perspective, the IRS is typically grandfathered plans that are currently in place. And then it also is important to note that if you lose money in your Super Roth, meaning like this year, the market's down, that is considered a permanent difference. So you can't use those losses to offset any gains, whereas you can actually do that in a managed portfolio. So just want to highlight a couple of negatives about the Super Roth. They're not huge negatives, but they are there and you need to know about them. Similar to the funding structure, from a conceptual perspective, as it relates to on-balance sheet plans, off-balance sheet plans kind of carry better economics, actually, because most people are taxed at, or income tax rates, which are typically 37%. So you're really comparing the taxes you're paying on your managed portfolio against the cost of the tax favored structure. And once again, to the right are just examples of the institutional managers that are accessible through the super Roth structure. So then we thought it would be of value to kind of do a compare and contrast using the example on the left. If an executive did move $250,000 a year for 7 years into a super Roth versus invested the $250,000 a year into taxable securities portfolio. Here again, these are after-tax contributions. The 8% earnings rate would be a tax-free rate on the super Roth. On the taxable securities portfolio, it'd be a taxable rate of return. You can see in this example, 45-year-old executive, if they received a payout between 60 and 80, there'd be a $2.6 million advantage of the super Roth over a taxable managed portfolio. 4.6 million if you took distributions out from 65 to 85, and then almost an $8 million advantage if you waited till age 70 and took payouts out until 90. The difference is the tax-free compounding. The longer that you can tax-free compound without taking liquidity and distributions from that super Roth, the more advantageous it's going to be to you from an economic standpoint. The other interesting thing about a super Roth is the cost structure as it relates to taxable securities. So the cost structure in a super Roth is fairly fixed at about 100 basis points in this example. But in a taxable securities portfolio, the higher your rate of return, the more tax you're going to end up paying. So we don't really care where tax rates go into the future, right? Because we're in a tax favored structure. But if you're not and you earn a 10% rate of return versus a 4% rate of return, a much larger part of your earnings are going to go to pay Uncle Sam versus a super Roth, which is fairly fixed at that 100 basis point structure cost. Still no questions? Okay, we'll keep moving. So the next off-balance sheet strategy we wanted to share that's been getting a lot of traction. Actually, I have a meeting this afternoon with the company about putting in this exact plan for their top executives is the loan regime split dollar plan. And what this basically is at the end of the day, it's the corporation loaning money to an executive. The executive is then allocating the dollars into an investment-oriented insurance structure, similar structure to the super Roth. The assets in that structure, however, are being used as collateral for the loan that was provided to them by the employer. The executive can pay loan interest, or in this example, we assumed a 0 interest loan to the executive. And then any excess cash that accumulates in that investment structure over and above the cumulative loans to the company waterfall back over to the executive. So if you didn't follow me, this might be easier to follow. So we provided you with a numerical example, and we assumed a tax rate of 37%, corporate tax rate of 21%, long-term AFR 3.14. As I mentioned earlier, this example assumes a 0 interest loan to the executive, a total loan amount of $1,050,000, and the executive is going to invest that $1,050,000 into an S&P 500 index. And we assume that index was going to earn 6% on average. The index has a floor of 0 and a cap of 9.5%. and the contributions are $150,000 a year over 7 years. So with those assumptions, you can see the detail here. So the loan amount is 150,000. You can see the loan balance in column 3. You can see the offsetting asset, which is the collateral for the company in column 4. And then the executive is going to take that $150,000 that they're loaned. There is a cost to the executive. So even though it's 0 interest loan, the IRS says, well, that's fine, you can do that, but we're going to impute income based on the long-term AFR rate. So there's tax on the AFR rate. Notice there's a repayment of the loan back to the company in 15 years. And then also notice that the waterfalling of excess cash is in column 10. So at age 65, this executive has a balance of over $1 million that's income tax free. And if they wanted to annuitize that or take distributions from that, they could get over $118,000 a year, almost about $1.2 million out of that plan. And then we'd like to calculate what's the return back to the executive, because they are having to pay those tax costs here in column 7. And so the returns are obviously extremely competitive on a pre-tax equivalent yield basis. It's, you know, depending upon the year, it could be as high as 30+%, all the way to around 20%, which is a phenomenal return without taking any equity market risk other than what the S&P 500 is going to do. But you do have a floor of 0 and a cap of 9.5. So this is off balance sheet because this asset is owned by the executive. It's not on the balance sheet of the company. And because of that, all the cash in column 10 is not subject to claims of creditors. So the cost to the company is really minimal in terms of whatever their cost of debt is. It could be, you can make the impact to the company from a financial standpoint 0 by charging the executive interest on the loan. But in this example, which is fairly popular, a 0 interest loan now is the best economics for the executive, and the company's, you know, net incremental costs are really not a material number. They're just moving cash from one place to another, and they've got a collateral commitment, and they're getting that cash back at some future point in time. Still no questions? All right, we're going to keep moving. So survey question number 3, do you have any executive benefit retention or attraction plans in place for your executive management team today?
Okay, Todd, sharing results.
Okay. So like about half the group has some plans and the other half doesn't. And then we have our 4th survey question, which is what types of retention plans does your company currently offer its execs? This might be helpful in giving other people on the call perspective as to what other companies are actually doing around attracting and retaining their key people. I believe you can check as many boxes as you like.
That's correct, Todd.
Okay. looks like we've got 66% participation.
Give it one more second and
Yep.
then I'll end
There's
it.
some other ones coming in.
Okay, good to go.
Great. So looks like we got a couple different comp plans, a few long-term incentive plans. So cool. Let's see.
Todd, we do have a question in the chat. Richard
Okay.
says that he assumes the plans with loans can't be used for public companies.
That is correct. You can't loan money to the executive because of Sarbanes-Oxley. So those plans are more prevalent for privately held companies opposed to public. That is correct. There are some alternatives to that where we've worked with third-party financing, banks and other institutions to provide the executive the loans, but the loan is not coming from the company directly, because that would fly right in the face of SOX. But there are situations where the executives can get a loan from a third party to leverage the same type of economics. So I know we took our own little survey. I thought it would be of value to share with the group our own executive benefit survey for the state of Florida. So these are publicly traded companies in Florida. This is companies with greater than 100 million in revenue. And you can see that 69% of the companies offer deferred comp plan, 24% serve long-term incentive plan, 45% some kind of additional supplemental life insurance benefits, and then 39% disability income, which is also popular. And you can see that and how that compares to the companies nationally. And then we also did one for Tampa Bay. So, but we divided it up a little bit differently. We looked at companies greater than $1 billion in revenue versus companies, you know, in the $100 million, less than 100 million in revenue. And you can see, obviously, there's a big difference, but still some prevalence of several, if not all, of the executive benefit plans that are noted. And then lastly, I know everyone might be thinking, well, is on balance sheet better than off balance sheet, and pre-tax versus after tax? What are those economics to the executive plan participant? And of course, I asked that question for myself. And the answer is it really depends upon where tax rates are today and where tax rates might be sometime out into the future. So if, you know, tax rates stay the same, if the current rate is 37%, you can see that the pre-tax plan to the executive is going to be more beneficial. If tax rates increase at 45%, you're kind of neutral. And if they increase at 50%, you're better off paying taxes today. So that means your super Roth structure will be better today, knowing the tax rates are going to be 50% out into the future. Here again, both the pre-tax non-qualified plans and the off-balance sheet super Roth plans are going to be better than a taxable securities portfolio. So it's important to note that. But I'm into structural diversification. So I think you should look at having a little bit of maybe both. So if your company is doing a deferred comp plan or long-term incentive plan, you might want to consider personally doing maybe a super Roth. So we did, and our analyst team put together what we call the indifference curve. That basically shows, should I do an after-tax plan? Should I do a pre-tax plan? when does it make sense? When does it not make sense? And this is a good way to kind of figure that out. And then lastly, I think it's important for everyone to understand, you probably already do, but if it's a non-qualified plan, it's typically becomes a team sport from a decision-making perspective because it's on balance sheets. You've got tax issues, accounting issues, balance sheet, finance. You've got the positioning of how do you want to champion this to our board or comp committee or maybe ownership. But the one constant is the CFO is always in the middle. So at the end of the day, the CFO is the decision maker because it is impacting the financial position of the company because it is on balance sheet. Even though HR is involved, even though the treasurer might be involved, or even the chief accounting officer or VP of tax, but typically the CFO being involved in that decision is really, really important. And the last question, and this is not a survey question, it's more of a did you know, and it's more about did you know that you can retain and attract other people on your team that are not highly compensated but are important key members of your team? Did you know that you could do that? And you could do that by using a non-qualified plan. So most people are not aware of that. Even people in our industry aren't aware of this. But there are ways to include, important people on your team, nurses, engineers, technology developers, drivers have been super important with a lot of our logistic and transportation clients. They're trying to attract and retain drivers because there's a shortage there. So there are ways to leverage non-qualified plan structure and creativity and optionality there to better attract and retain important team members that are not necessarily highly comped. And that is it. I think I've got 5 minutes if there's any additional questions.
Does anybody want to unmute and ask Todd a question? Okay, quiet group.
Well,
Thank you
maybe I
so
put them
much,
to sleep.
everybody.
I don't know. I
Have a good
appreciate
day.
everyone's time and hope you found this to be of value. And thanks for the opportunity to share some ideas.
Thank you so much. Bye-bye.
Thanks. Thanks, everyone.